Hi, everyone. My name is Beth Boland. I am the former president, now the chair of New England chapter of NACD. We welcome everybody to this next program in our virtual series that we have been conducting since March of 2020, and soon will be in person. But for now, we are delighted to welcome everybody in this group to this next program that we have, a fireside chat on current economic conditions featuring Eric Rosengren, the president and CEO of the Federal Reserve, and Cathy Minehan, who is the former president and CEO of the Federal Reserve Bank of Boston, but now the president of our New England chapter of NACD. We hope that everyone is able to stay on camera if you can during the course of our program here today. And I'm also trying to get my meeting notes here in front of me.
We can't hear.
Okay. Can you hear me now? Can you hear me now?
Yes. We can.
Okay, great. We will be monitoring the chat function. So you can post your questions there, but also lots of times we have folks really start up their own conversations about points that some of the speakers make, some additional resources that you might want to share with your fellow attendees. So please feel free to use that chat function for various different purposes in addition to your questions. But we will be focusing on your questions too during the course of it and want to try to get to answer as many of those as we can. After the program is done, we will ask you, we will beg you to share your thoughts and comments on the program by filling out the post-event survey. You'll receive that in a separate email right after the program. So look for that and please do us that favor. We really do look through those responses and try to respond to them as we develop our programming. If our first slide, if we can bring up the slide of our chapter sponsors, I do want to thank our chapter sponsors. Trust me, there is no way we could put on this program and no way that we have the great staff that we do without the support of those sponsors. And in particular, I want to highlight our spotlight sponsors for today's program, Egon Zehnder, Protivity, and Stone Turn. Each one of them has been a long-standing sponsor and supporter of this chapter, and our heart and our best wishes and our thank yous go out to them in particular for their deep support of our programming. With that, I think we will be kicking off the program and I will turn it over to Cathy Minehan.
Thanks so much, Beth. As Beth mentioned, I'm Cathy Minehan. I'm the president of the NACD New England chapter. But most importantly for this program, I'm the host of a fireside chat with Eric Rosengren, the 13th president of the Federal Reserve Bank of Boston and my successor in that position. He became president on July 23rd, 2007, and has served on the Open Market Committee which sets the policy for interest rates for the whole country. He's had 3 or 4 different rotations on that. So we're just pleased to have him here as a speaker. I should mention that unlike many presidents of reserve banks, Eric has expertise in both monetary policy with a PhD in economics from the University of Wisconsin and in supervision and regulation, having been the senior vice president in that area at the Boston Fed prior to becoming president. And the Federal Reserve Bank of Boston under his leadership has continued its key role in supporting the nation's payment systems. So for the Fed groupies on this call, and there are probably more than a few, Eric has hit the trifecta of leadership roles in the 3 major areas of Fed responsibility: monetary policy, supervision and regulation, and payment systems. To his credit, Eric has used his wide range of expertise to focus on financial stability issues and their impact on Main Street. As examples, the Boston Fed hosted foreclosure prevention workshops for New Englanders during the Great Recession 10 years ago, and operates the pandemic-related Main Street lending program to provide loans to small and medium-sized businesses and nonprofits throughout the country. So we are really privileged. We welcome your comments, Eric, to start off our chat.
Thank you very much, Cathy. Thank you for the very kind introduction. And as usual, I'm going to start with some data. It's an occupational hazard that I love to look at data. So before we have our chat, I'm just going to lay a little background information down to help us characterize what we're going to be talking about. Next slide, please. So I think the most important message is that we really have quite a robust recovery that is underway. The economy is opening up faster than we would have anticipated 5 or 6 months ago. Vaccination rates, particularly in New England, but throughout the country, have occurred more rapidly than we anticipated. And as a result, businesses are reopening much more quickly. We are seeing GDP forecasts now that have been upgraded significantly since the beginning of the year. The participants at the FOMC are no different than private sector forecasts in this respect. So at our last meeting, there was a June FOMC meeting, we provided a forecast for a variety of variables, and the median forecast for GDP this year was 7%. 7% is not the normal recovery. That's more like a number that you would expect from an emerging market, not a developed country like the United States, and really highlights how strong the economic growth is expected to be over the course of this year. With that kind of growth, we need to hire more people or rehire more people, and that's a very positive sign for the economy. Getting back to full employment has been a goal of the Federal Reserve. We currently have an unemployment rate of 5.8%. But we're expecting by the end of the year, our median forecast among the participants was 4.5%, which means we're getting very close to at least some people's estimate of full employment. In terms of inflation, something I'll talk a little bit about on the next slide, the Federal Reserve forecast has PCE inflation, which is basically the measure that we focus on. I'll focus on the core measure here, of 2.1%, just slightly above our 2% target. So obviously we're going more rapidly than that right now. So that implies that we do expect that while there are elevated prices for many goods and services right now, that there'll be more moderate growth as we get into next year. I would highlight that while this is a very optimistic forecast, there are many sectors of the economy that are still suffering greatly from the pandemic. And I will be highlighting in my brief remarks here about how much room we still have to go before we're back to where we were prior to the pandemic. Next slide, please. So this first slide highlights inflation. And as I mentioned, the inflation measure that the Federal Reserve focuses on is the personal consumption expenditure estimate. It basically runs very similar to the CPI, but runs roughly 0.3% lower in general than the CPI, has slightly different weighting for some of the components, but broadly they move together. I show you three different estimates here. The dark blue line is the total measure. I guess light blue is core PCE, which just takes out food and energy. And the green line is Dallas Trim Mean. What the Dallas Trim Mean is, it takes out the outliers at both ends of the distribution, gives you a better idea of what is happening to prices that are not kind of experiencing unusual movements at this time. So starting with the total PCE in the dark blue, you can see that currently PCE is at 3.6%, well above our 2% inflation target. Our inflation target is on total PCE, but we do look at other inflation indicators because we care about how persistent the price changes are going to be. So just the difference between total and core is primarily it's food and energy, but really it's energy prices spiking up that have caused the difference between those two. So once we take out the food and energy, we're down to 3.1. And if you looked at the trim mean, it goes down to 1.8%, actually below our 2% inflation target. So why do we see such different measures? Well, there have been a variety of things that have happened over the course of the first 6 months, many of which have been somewhat unexpected. Because the economy opened up so quickly, there definitely are shortages in supplies of a variety of goods and services that we normally don't experience during a recovery. A second area that's important to note is that we're looking at year over year inflation changes. And a year ago, we were still in the midst of the pandemic. Many firms had dramatically lowered prices in order to get inventories down as the economy was shutting down. As a result, the basis for looking at inflation is being measured relative to kind of the low point in the pandemic. I would also say for many goods and services, particularly services affected by the pandemic, that more recently over the last couple of months, we've been seeing basically a repricing to a more normal price structure. So if you wanted to buy an airplane ticket 6 months ago or stay in a hotel 6 months ago in downtown Boston, you would have paid a very different price than what you're paying right now. But if you compare that airline ticket or that hotel price to what we were February 2020, more than likely it's relatively close to what we were experiencing at that time. So some of this is just a repricing back to normal. Overall, most Fed speakers have talked about expecting inflation to come back to 2%. That is my forecast as well, that I expect us to be slightly above 2% as we get into next year. That's very consistent with the survey of professional forecasters, or the blue chip forecasts, which are a set of roughly 50 private sector forecasts. So I think the Fed's expectation that most of the price movement that's occurring this year is not sustained into next year is actually a pretty common forecast. Though obviously it's very easy to make headlines out of the fact that both this blue and green line have spiked up, but or the dark blue and light blue. But I would highlight that the green line has not, which says that those outliers are really making a difference. One last example, something like used car prices have gone up quite appreciably, but we don't expect used car prices to continue to rise at the pace that it has over the last couple of months. The chip shortages and the inability to sell new cars have inflated the used car market, but we do expect as we get into next year, we'll see more chips, we'll see more new cars, and we won't see quite the same prices on the secondary market for cars as we see right now. So that's just an example. Also, lumber prices that went up quite dramatically the last couple of months have more recently started to decline a bit. So we're already seeing some of the surge being reversed in some of the commodity prices. Next slide, please. So the first chart was on inflation. The second chart is on employment. And those are the two elements that the Federal Reserve focuses on. And what this chart looks at is payroll employment scaled to where we were pre-pandemic, February of 2020. And so if we had fully recovered, you would see that the goods producing total, government service producing categories would all be at 100 or above. And what you see is the exact opposite, that in terms of employment, we're still well below where we were. While goods producing industries have come back pretty rapidly, it's still below where we were in February 2020. And if you look at service producing sectors, which includes tourism and hospitality, restaurants and retail, that sector has come back more slowly and has quite a ways to go yet. So it just highlights that we still have a fairly large gap in employment to make up if we're really going to get back to full employment. Next chart, please. So another way of thinking about how much of a gap we have in employment is to look at the employment to population ratio. And the employment to population ratio here is again scaled to February 2020. So a negative number indicates that the employment to population ratio in that age cohort is that negative number is indicating that we're 2, 3, 4% below where we were in February of 2020. And we have two different categories by gender, men and women. And what I want to emphasize here is that the pandemic has affected people in very different ways. And I'm using gender in this slide just to illustrate one of those ways. So while overall, the employment to population ratio for men has declined more than women, when you look at age cohorts, it's a very different story. So if you look from 16 to 44, those age cohorts, which tend to be the age cohorts that you have families and have children, particularly younger children, you see that the female employment to population ratio has actually declined a bit more than the male, indicating that many women have had to pull out of the labor force in order to take care of family responsibilities. Not that men don't do that, but for many families, it is a woman who is making that choice. When you look at the age cohorts above 45, you see that that pattern actually reverses quite significantly. And while both men and women are well below where we were in February 2020 in terms of employment to population, and in this instance, you're seeing men have pulled out of the workforce much more than women. Just one of the many ways that the pandemic has very significantly affected various groups within our population very significantly. Next slide, please. So how does the employment data that I just showed you square with the observation that there are so many restaurants, hotels, and retailers looking for employees and having difficulty finding them? Some of that is tied to immigration and visa policies. So when I talk to businesses on Cape Cod or in coastal Maine, I certainly hear about how immigration status has affected their ability to get the kind of seasonal employment that they normally would have. But I would also say that that previous slide that indicated the age cohorts really affects things like leisure and hospitality and retail trade. These are professions that frequently have younger people, and frequently women of childbearing age are in some of these categories. And they may not be ready to go back, either because they don't have someone to take care of their children, or because they're worried about the public health. And many of these jobs are jobs that you actually have public faces to. So if you're working in a store, if you're working in a hotel, you're probably having a lot of contact with people, some of whom will be vaccinated, some of whom will not. And you may just not be willing to take that much of a risk for a job that's not paying much more than minimum wage. So you do hear a lot of complaints, but many of the complaints are in the types of jobs that were both affected by the pandemic, and that there's still some public health risks, at least in the perception of some people's mind. So you can see that in order to attract people back, you are seeing things like leisure and hospitality, construction and retail trade are seeing faster average hourly earnings than for the total number. The total number is the dark blue line with 2% for average hourly earnings. That's well below what we were experiencing in the time prior to the pandemic, as you can see. And I would highlight that what we're seeing in retail trade, construction, leisure, and hospitality is not what we're seeing in all industries. If anything, what's surprising at this point is that we're not seeing average hourly earnings overall even a little bit higher. So over time, we would expect average hourly earnings would pick up. You certainly would expect average hourly earnings to roughly approximate what you think inflation is going to be, and the Fed's shooting for 2% inflation and some measure of productivity that goes to labor as well. So right now, average hourly earnings actually is on the low side relative to what we would expect once the economy gets back to full employment. Next slide, please. This is my final slide, and what I want to emphasize is one of the reasons that we're having such strong growth is that we've had very unusual monetary and fiscal policy. So it's pretty unusual to have both fiscal policy that's highly stimulative and the degree of stimulus that monetary policy is currently providing. And that's one of the reasons that we're expecting a very robust recovery, but with very low interest rates and a high degree of stimulus on fiscal policy, we do need to think about financial stability issues. And this is just highlighting one area that I think also has gotten a fair bit of attention. Housing prices have moved up across the country. I was hoping to do a slide that would differentiate a little bit between rural, suburban, and cities, but it took a little longer to get that slide together than I had hoped. But this does give you an idea of how much housing prices have gone up in metro areas around the country. I would particularly call your attention to kind of the last 6 months. And what you see in a number of the cities, including kind of Boston, Denver, and Los Angeles, just to pick 3 from the top, you see that line going up very dramatically with a steepness that's not dissimilar to what we were experiencing in the 2005 to 2007 period. So I do think we have to worry about housing prices in a boom-bust scenario. I'm not predicting that will happen, but I would highlight that this is something worth closely monitoring. If we continue to see housing appreciation like we've been seeing, I think over time we'd have to take a hard look to see whether we're getting some spillovers from some of the monetary policy accommodation that we're having, and think about ways to mitigate that. There are plenty of other financial stability issues. I'm going to talk in a fireside chat about financial stability at the end of this week. But this gives you a rough idea of some of the main data that I'm looking at right now. And I think now is the time to start the chat with Cathy.
Thanks so much, Eric. As usual, your charts and your description of your thinking and so forth is so clear. What's going to happen now is I'm going to pose a few questions. Eric and I are going to have a chat. And there'll be some time, 10, 15 minutes at the end to take questions from all of you. And there have been a couple already in the chat, and I'm going to rely on my colleague, Ellen Richstone, to take the questions in the chat and group them together and see if there are issues that we need that, need special focus at that point in time. So your friend and mine, Larry Summers, former Treasury Secretary, current and former professor, not to mention president of Harvard. He's gone on the record pretty forcefully over the last couple of weeks anyway, maybe before that, saying that the risks of inflation are now higher than he thinks the Fed believes they are. And I don't mean transitory inflation, which I know you're relying on reported data, which is always the best course of action, Eric. But he would argue that, in the last couple of months, that's far exceeded the numbers for the PCE. He had a guess, I guess, at 8% or even better. But he put the underlying rate, if you take the transitory elements out, is way over 3, which is consistent in at least the 3 number, with what some of the Reserve Bank presidents were projecting for the year as well. It was a little bit of a surprise to some people, but it didn't rock the markets when the Fed's forecast data last week raised the likelihood of interest rate increases sooner rather than later, sooner than had been expected in earlier data, in the earlier forecasts that Fed presidents had. I'm sort of interested to know how you're weighing these risks.
Yes, that's a good question. And I think inflation obviously is a very important issue right now. And there is clearly heightened uncertainty. We tend to rely on historical data and historical relationships. And fortunately for humans, but unfortunately for forecasters, we don't have a lot of pandemics in our data that can really give us much information about how prices over time are going to act. So I do think that the risks are heightened, and we should be highly attuned to those patterns. To the likelihood that we see persistent inflation at 3%, as a modal forecast, I think it's not a particularly good forecast. So we may see it for this year, but that will be transitory. I think what's more relevant is looking at next year. So the forecast for the median forecast for the FOMC was 2.1% for next year. When you look at professional forecasters, they have a very similar forecast. And if you look at a 10-year Treasury rate, It's currently trading roughly at 1.5%. You're not going to lock in a 10-year treasury rate at 1.5% if you think inflation is going to be at 3%. So financial markets aren't pricing assets as if they expect inflation to be 3%. Now, just because the financial markets forecasters and the Fed don't think it's going to happen doesn't mean it won't. But the scenario that it would require is that people start taking what's happened that the Fed currently thinks is likely to be transitory and start expecting it to be a more permanent increase. And so we see wages across the board, not in certain sectors, but in general, starting to expect a 3 or 4 or 5% inflation rate. That's not in any of the private sector forecasts. I don't think there is a private sector forecast in the blue chip that's over 3% right now next year. So that's an outlier forecast if someone is forecasting 3% to continue past this year. But that being said, I would take that risk element quite seriously, and how expectations are set are not well understood by economists or financial markets for that matter. And particularly coming out of a pandemic, relationships may have changed. So I think we're going to have to watch the data over the course of this year to see if it looks like it's much more persistent than we're expecting. I hope it's not. I mean, we're looking for inflation a little bit above 2%. We're certainly not looking at numbers that continually are going up with a number starting at 3 or higher. So I don't expect that will happen. But I, like my colleagues on the FOMC, are going to be highly attuned to how the data comes in, and will respond if it's necessary. But my expectation is that the most likely outcome is most of the price increases we're seeing this year will be reversed as we get into next year.
You know, we went through a period prior to the financial crisis in the early to mid 2000s where there was this idea out in the market of the Greenspan put, i.e. you could do anything you wanted to do, and if things got bad, Greenspan would step in and the Fed would stabilize financial markets. And we've seen a lot of stabilization of financial markets during this pandemic, to the Fed's credit, doing things that had never done before, but had to do now to really push money through the system and get people to spend when they became comfortable doing so in the midst of the pandemic. This idea of the Fed intervening and saving everybody from themselves, if the markets keep expecting that, it could lead to the kinds of financial instability that we've seen from time to time. I'm just wondering how that financial instability affects people as they think about the way forward, which of course is, you know, has an enormous array of range in terms of expectations and what people think might happen.
Yeah, I think it's a very good question. I certainly support all the unusual actions that we took in March and April to stabilize the economy. The pandemic was a very unusual event. It was a global event. It was a public health crisis, not really we amplified it with some of the structural problems in financial markets. But overall, it really was a public health crisis. And so I think both very strong fiscal and monetary policy actions and the kind of interventions we took were definitely necessary. But I do agree that we've had 2 very significant interventions in the last 2 recessions. And we need to do more work to make sure that we don't continually have to do this. One reason we want a 2% inflation rate is to give us a little bit more room to lower rates when we have these kind of shocks. So we had been at fairly low interest rates and fairly low inflation rates going into the pandemic. The result is we hit 0 interest rates very quickly. And that means that monetary policy, at least the traditional monetary policy tools, can't be utilized at that point. And so it requires extraordinary measures. So one way to avoid extraordinary measures is to hit our 2% inflation target and have more normalized interest rates over time. But I think there are a variety of other things that we need to continue to look at. Money market fund reform, bond market reform, thinking about what's happening in some of the cryptocurrency markets and other areas are all areas that I think we need to pay special attention to. And I do think that there are areas where we need to make sure that institutionally we're better prepared. I would also say that long periods of very low interest rates do encourage people to take risks. And when people take risks and unexpected things happen, it can create distortions that we didn't expect. And so I think while we want to get to our inflation and unemployment targets, we have to be mindful of the financial stability concerns as we're doing that.
I couldn't agree more. You've talked a little bit about, or mentioned anyway, cryptocurrencies. One of the things that people lose sight of sometimes is the role that the Fed plays in the nation's payment systems. Again, an important aspect of financial stability. Just as a background for those of you who may not be as close to it as certainly Eric and I are, the Fed processes and settles for large transfers of funds and securities and provides net settlement services for the overall payment system. It just settles right through the Fed. It also operates a low value system called ACH, or Automated Clearinghouse. The Fed of Boston has a really key role in payment systems in the United States. It's deep into the development of a replacement for the ACH, which is known as FedNow. It will allow same-day transfers of low value amounts normally on a 24/7 basis from individuals through the banking system to the Fed. As a kind of introduction to the whole cryptocurrency topic, how are we doing with FedNow, Eric? And how is Boston seeing the progress on that?
So you gave a great description of FedNow. It's a really important project. It's the biggest payments project that the Federal Reserve's undertaken in 40 years. And I would say that in the United States, there's not, we don't have the same regulatory apparatus that we have elsewhere in the world. And as a result, we have not been as innovative on the payment side as in many other countries. And I know Cathy certainly knows this from her experience. But what we're trying to do is many of our systems are designed to basically be open 5 days a week during business hours. We're going to a 24/7, as Cathy highlighted, 365 days of the year kind of payment system. And we want to have that instant, or as close to instant as we can make it. And so what FedNow is trying to provide is basically the backbone to do that. And we want to be sure it's resilient, because it's going to be the backbone for the payment system. We want to be sure that you can use it no matter where in the country you are. So if you're in a rural, remote place, you still have access to it, and that may not be a profitable part of the business. And we want to be secure. We don't want foreign actors or others to be able to take it down. And so it is a very important project. I would say that we're making great progress. We're expecting that we're going to have the first release in 2023. We had originally announced 2024. Frequently with these projects, you move them back, not forward. So it's a good sign that we're actually moving it forward. It's a very complicated project, not only for the Fed, but also for the banks. So the banks are going to have to do a fair amount of IT work themselves in order to be interfacing with the Fed. We're working very closely with the entire banking system to try to make that happen. So some of this is a big IT project, but some of this is also making sure that everybody, most countries don't have the thousands of banks and credit unions that we have. It makes it much more complicated than if you were in Canada or some other countries where you have 5 or 6 players. And if you have the big organizations, you get the vast majority of the transactions. So it is a very complicated project. It's going on very smoothly. And I think when people talk about digital currencies and some of the use cases for digital currencies, FedNow is going to serve many of those roles. So we're going to have the first release in 2023, but I think there'll be several subsequent releases that provide greater functionality over time, including potentially international wire transfers and other things that are currently quite expensive and bulky to do. You could imagine a FedNow system being highly effective at giving you almost instant payments across national borders. So I'm very excited about the project. Ken Montgomery, my first vice president, is the person really responsible for doing it. So while the Boston Fed's doing it, Ken deserves a lot of the credit for all the work that he's doing on it. And he's doing just a fabulous job, and I'm very excited about it. I would highlight also that a lot of banks are in a pilot that are working quite closely with us. And so far that pilot's working quite well. And we've been surprised by how many institutions have been anxious to participate in that pilot.
It's terrific. And it is really credit to your leadership, Eric. And I see Paul Connolly on the call. Paul was the first vice president prior to Ken, and set a lot of the groundwork and the capabilities of the bank to do what you and Ken are doing now. So it's terrific. So that takes us to the really sexy topic of cyber currencies, and in particular, the possibility of a central bank issued cyber currency known in Fed and central bank lingo and financial lingo by its initials, CBDC. Such unbelievable people as Chairman Powell and Governor Lael Brainerd are both on the record speaking in Congress, I believe, and Lael was on a show, one of the financial programs, with a long discussion of cyber currencies and all the relevant issues associated with them. And I know that the Federal Reserve Bank of Boston is also working on cyber currencies with MIT. I'm really interested in what your thoughts are on this. It's such a hot topic right now, and your perspectives, I think, would inform everyone.
Yeah, so I would say this is an area that's just developing and has quite a ways to go. There's the policy side, which is largely going to be determined by the Board of Governors and Congress and others on exactly what is the problem they want the digital currency to solve. And then there's the technology aspects, which is how do we create the ability to have a digital currency? So what do we mean by a digital currency? We're really literally talking about equivalent to cash, but you use your phone rather than carry cash in your wallet, and that you can do the transactions presumably through a wallet on your phone that enables you to more easily assess digitally any kind of transaction that you want to do, and that you can transfer funds anywhere in the country, anywhere in the world using this technology. So there are technology challenges to doing that. I would highlight that there's a lot of Bank Secrecy Act and worried about terrorist financing. We also have to make sure that it stays secure and doesn't have a cyber attack in its design, which would be a real problem. But in terms of the technology of being able to processing a large volume in a short period of time, we're going to be coming out with a study in early July that indicates that we have some promising technology already that we think could actually do it. Now, there's a lot more work to be done, and as you add more bells and whistles, it gets far more complicated to do, and it slows the technology down. But what we're trying to do at the Boston Fed is to make sure that whenever the policy decisions are made, if they are made, that we have an appropriate set of technology specifications that we think we can go live in a reasonable time. I would say there are a lot of synergies between the digital currency and the Fed now. So international transactions is one of the use cases for a digital currency, to be able to move dollars anywhere in the world virtually instantaneously. Well, we can hopefully do that with Fed Now. The ability to just be able to digitize and work digitally with the currency is something we can also do with Fed Now. And as you go through a variety of the reasons for why we want a digital currency, the one area that I think digital currency has an advantage is for the unbanked. So currently in our system, there's a significant percentage of people who don't have bank accounts. And part of that may be concerns with banks. Part of that may be that the fees, particularly for low-income individuals, sometimes makes it prohibitive to access the banking system. So a digital currency that either went through the banking system but in a no transactions cost way, or did not go through the banking system would have the possibility of reaching the unbanked population in a way that a Fed now that primarily works through banks could not. Now, there may be solutions to that if banks were to have no transactions costs accounts that attracted people that are currently not in the banking system. But at least to date, that hasn't happened on a widespread basis. So I think it's a very exciting area. Obviously, there's central banks around the world are working on this.
Mhm.
China's probably the furthest along, but I would say there are a number of other countries, and the ECB is working on it as well. So we will have a working paper on the technology aspects. The Board of Governors is going to be working on the policy aspects and coming out with more information on that, hopefully over the course of the summer. So I think this is an area to keep watching. It's certainly gotten a lot of congressional interest and a lot of interest in other places as well.
Yeah, well, taking the financial system out of payment system transfers and having the Fed be the starting point and the ending point is really controversial and really game changing for a lot of things. So I know we're all looking forward to that report. I like the way you focused on the potential for central bank digital currencies and even FedNow, if the pricing is right on it, to help people lower down in the income spectrum. And I think that taps into yet another really strong point of the Boston Fed. In 2013, the Boston Fed produced a remarkable analysis of what turned out to be an extraordinarily large wealth gap between African American and white families. This study, I believe it's called The Color of Wealth, what remains one of the few studies of this problem. And I know many people have asked me, do I think the Boston Fed is going to update it? I'd love to hear your perspective on that. Not that I think the gap has gotten any better, frankly. It's probably gotten worse, but it would be good to have current data on it.
Yeah, we're doing a lot of work in this area, including thinking about subsequent work that goes beyond what that study did. So I think another study that just replicated would probably show gaps that are pretty large still. So what we want to do is, if we do another study, make sure that it gets more at what we can do about it, as opposed to just documenting what the size of the gap is. We're currently working with a variety of players around Boston and around Massachusetts, thinking about how we could design a survey and how we could do something that would give us a better indication of what causes the wealth discrepancies. So part of it is a survey, but part of it is maybe matching it to other government data and really doing a comprehensive study to understand how much of it is housing, how much of it is related to employment, how much to education. So what that previous study did was documented gaps, but it didn't really document solutions. Mm-hmm. And so I think now's the time to start thinking about the gaps have been pretty well established. What can we do about it? I would highlight there are other areas that we're looking at the Boston Fed that are trying to address some of the same issues. We've had a working cities competition that's focused on industrial cities around New England. All the states except for New Hampshire have participated at this point. We recently had Connecticut decide that they were going to expand on that program. The state legislature decided to expand on that. And the Vermont legislature has also recently decided to also expand on that. So that is an area that we're focused on, cities that have a disproportionate number of low and moderate income individuals that haven't performed as well as, for example, Boston has done. And I think that's very exciting work. It's collaborative work. It's difficult work, but it's also important work. And we have to remember not everybody's in Boston, that there are lots of other places that need this kind of work to be done. I would also highlight that the Boston Fed is working with the Atlanta Fed and the Minneapolis Fed on the Race in the Economy series. And it really has been a different kind of series that's tried to give different perspectives on how race has played a role in some of these discrepancies. So we talked about both employment and wealth. If you typed race in the economy on Google, you'd actually see that. We have another one coming up in about 2 weeks. It tends to have 6,000 to 7,000 people show up for those events. And I think it's an important understanding of how we got to where we are. So this is an area that the Boston Fed is going to continue to be doing a lot of work on.
That's terrific. I'm glad we've been able to cover almost all the aspects of the Fed in some of our questions and certainly in your answers. Now I'd like to turn it over. Ellen has been watching the chat. Ellen, if you wanted to just let me know where the questions are.
Why don't I go to the first one, Cathy?
Okay.
The first one that I think to focus on would be, given the large debt and continuing large deficits in the US, how do you think this is going to impact the US dollar and its preeminent position as a global currency? What do you think the impact will be? We'll start with that one.
Sure. Let me talk about fiscal policy more generally. So during the pandemic, just like monetary policy did extraordinary actions, fiscal policy has also done extraordinary actions. And I think it really made a difference to have programs like the PPP program and many of the other types of programs that the fiscal authorities implemented. Monetary policy alone would not have brought us out of the pandemic. We would not be seeing growth numbers at 7% or higher for this year if we didn't have a lot of fiscal stimulus. So first of all, I think actually this is an appropriate time to have a lot of fiscal stimulus. That being said, you can't continue to have the kind of stimulus that we've had recently because you don't want to have this kind of stimulus during a period where we're back to full employment. So if our forecasts are right, as we get into next year, we're going to be at or possibly even below full employment by the end of next year. We're going to be at a place where inflation is probably a little bit above 2%. That's an environment where you don't need the same degree of fiscal stimulus. So the appropriate fiscal action would probably be to either raise taxes or cut spending. Now, I can't predict that that would actually happen. Obviously, the Federal Reserve has no ability to do anything about that. But I do think that not only the United States, but countries around the world have taken these actions. So we're not alone in using fiscal policy quite dramatically during the pandemic. One of the good aspects, though, is that because we have the vaccine that many other countries don't have, we probably won't need the fiscal stimulus for nearly as long. So we're likely to be pulling back on the fiscal stimulus much sooner than Europeans, and certainly much sooner than many emerging markets. So when you think about the dollar, you have to think of it relative to another currency. And I think the rest, so I would not bet against the States just because
Eric,
we're deficits.
You're fading out.
Sorry. Is that better?
That's much better. Thank you.
Yeah. So since you have to consider ourselves relative to other countries, I still think that the United States is pretty well positioned over the next couple of years. That being said, it does require that we take appropriate fiscal actions when it's time to do so.
And of course, we know the Chinese are interested in their currency being the currency of international trade. So there's always that challenge as well. Ellen, next question.
So I would go to the one on Brexit. And really what I would focus in on Brexit is there has been some impacts with the detangling of the British pound from the euro, some questions about issues in the credit markets because of it. What is the view of the Fed in terms of the short-term and longer-term impacts of Brexit?
Yeah, and Brexit was a very big decision. It was a decision by voters in the UK. I would say it's become more complicated now that we have the pandemic, and Europe is pretty far behind the United States in vaccination rates, and they're having much more difficulty as a result of the new variant. Part of that is the strategy of the UK. With the new variants, they may not be as effective if you've only had one shot, and for many people in the UK, they've only had one shot. So I think actually more important than Brexit is getting through the pandemic for the next 6 months in Europe. And I think that's their biggest challenge, and it's the biggest challenge in the UK as well. But I do think over time, areas of particularly in financial regulation and what's going to happen there, I think is a critically important area that it remains to be seen how it fully develops. So London is clearly a financial center for the world. It's a very important center. The rest of Europe wants more of those activities to be located on the continent now that the UK has pulled out. So I think that's one stress point that I think is particularly important. And there's still a number of trade issues that need to be resolved. For the UK and for Europe, Northern Ireland still poses plenty of challenges. And if that starts creating trade disagreements, that would be unfortunate. The last thing Europe needs right now is a trade war on top of everything else. So my expectation is that those issues will get smoothed out. And hopefully people will primarily be focused on actually solving the pandemic, getting everybody vaccinated. Tourism is really important for Europe. Until they get the infections under control, it's going to be a place that a lot of people aren't going to be in a rush to be visiting. So both for their local population, but also because tourism is such an important component of their economies. I think that's the first order. I think Brexit is important, particularly for the UK economy. And what happens in the financial sector in particular, I think, is something that bears watching.
Okay.
I have a question. I think it's from Paul Connolly. To strengthen financial stability, do you believe we need both private sector reforms and new law and regulation? What critical few measures would you recommend?
Yeah, there's a number of areas that I think we saw stress points during the beginning of the pandemic. The Boston Fed, as well as doing the Main Street facility, did a money market liquidity facility. This is the second time in 10 years that I've been in charge of a liquidity facility for money market funds. The money market fund reform that occurred after the last crisis actually made things worse. And so far, there has not been a solution. If you look at government money market funds, they did just fine. It's the prime money market funds. Without going into a lot of detail, that's an area that needs to be cleaned up. A second area is our government securities market is the basis for our entire financial market. And that market became dysfunctional in March and April. That's a real problem. So we need to do a better job of making sure that financing of treasuries continues. I would include mortgage-backed securities in that as well. And that market is robust to shocks. It isn't right now. Over time, I'd love to see central clearing. That will take a lot more time than a few months to get done. But I think it's incredibly important. A third thing is countercyclical capital charge. We had to reduce a number of bank regulations to make sure that we got enough lending. We have left the countercyclical capital charge, which allows capital to go up and down depending on how the economy is doing. We left it at zero, so it wasn't really a buffer. And I think we should re-examine that. The final thing that I would highlight is that I would take a close look at what's happening, particularly with stable coins. We had basically a collapse of a stable coin last week. I'm going to talk a little bit more about this at the end of this week, but a stable coin is a misnomer, at least for many of the constructs. And so I think it's important to take a hard look. If you're somebody who's investing in stable coin, you should really understand the structure, because many of them, I don't think, are particularly structurally sound, and actually in some cases have some of the same characteristics as the prime money market funds.
Fascinating. Ellen, more questions?
Yeah, there are a couple more, but the next one I would say is that early on, Eric, you had showed us charts about employment, and the question from earlier was, what about the very real effect of payments to unemployed that made it attractive not to work? And do your numbers that you have an inherent bias in that? In other words, have they been impacted by those people choosing not to work because of payments?
Yeah, so certainly in some areas, the fact that we have enhanced benefits until September is going to make a difference for some people making a decision. But I think you have to think about that in conjunction with if you were in a part of the country that wasn't particularly well vaccinated, Would you want to be a waiter or a waitress at minimum wage when you didn't know whether somebody potentially had one of the variants? And so you may decide, partly for public health reasons, that you're not interested in doing that job until a higher percentage of the population is vaccinated. And those benefits make it easier to make that decision. There's no doubt about that. But I would say that we should be looking as much at the public health problem as we're looking at the employment benefit problem. And if we had everybody vaccinated, people would feel much more comfortable to take mass transit. People would feel much more comfortable in face-to-face jobs. And the fact that we haven't really resolved the public health issue, I think after we get through to September, assuming that the benefits don't continue, that there's still going to be a lingering problem getting people to do those jobs. Because if the public health issue hasn't gone away, and at least some epidemiologists think it's going to be worse by the time of the fall, that we're in a lull now, and it'll pick up in areas of the country that are not particularly well vaccinated. And if schools have to close down again, all the child care issues come back. So I think it's a very complicated issue. I think many people are using the employment benefits as a panacea. And once we hit September, all of a sudden, everybody's going to have plenty of workers. I don't think that's going to be the case. If anything, I think that the labor markets are going to tighten more. And many of those employers are going to have to think about a different model of attracting people to those jobs. So you need more of a job ladder. You need to have a different compensation package that includes health benefits and time off for sick leave. I think there are a variety of other things. I think the tight labor market is here to stay for a little while. So while we will see what kind of impact when September comes around, I don't expect that that's going to solve the tight labor market. I think actually we're going to find out it does relatively little to solve the tight labor market overall.
And that puts a lot of color around the idea that there's a lot of risk in the inflation forecast as well. Let's see, levels of unemployment and inflation, we've started to believe they don't relate to one another. But if you get yourself in a situation where you have to raise you have to raise the salaries that you pay everyone, particularly at lower levels, which would be good for them, it's going to have an impact on overall price increases as well.
Yeah, this is one way income inequality is resolved, to be quite honest. So
right.
Most of the service sector is got very low wages. And I think coming out of the pandemic, they're going to have higher wages. And to some respects, that is going to help with some of the income inequality. I'd much rather do that by bringing people up from the bottom than taking from the top. So I think this is an opportunity for people to rethink kind of that employment contract, particularly for workers that have traditionally been very low paid.
And that was the essence of the new, or I would say really focused change that the Fed put into how it's thinking about inflation that it talked about last fall, really looking at pushing a lot on where unemployment is and letting it go lower and lower in order to bring people up and not worry about the inflationary impact. It's going to be interesting to see how that tendency or that predisposition to do the right thing in terms of helping people move up the line translates into Fed policy toward inflation and then the financial stability or instability that might come with that. It's a very interesting time right now.
Yeah, I would agree. I mean, the framework change partly was a reflection of having a decade where we didn't get to 2% inflation, and labor markets we had too much unemployment for too long. And so we actually lost a lot of output and a lot of employment during that period. So I do think that it's not just so that we can deal with parts of the labor market that may benefit the most from a tight labor market. It's also just the fact that we didn't even have a tight labor market and we never got inflation to 2%. So I think that is the major motivation for why we're doing it. But there is a side benefit, particularly for parts of the labor market that traditionally have had much higher unemployment rates than the rest of the labor market.
Well, we've come to the end of our hour, and I can't thank you enough, Eric, for the time and your extraordinarily breadth and depth of your comments. We've all been really fortunate to hear from you in a very, very timely way. And I know all of us will be trying to find out where you're speaking on cryptocurrencies and how we can get in on that Zoom at the end of the week. Let me make a couple of announcements at the close of our program. As Beth mentioned, you're going to receive an email from us for your post-event survey. Those responses are really important to us. We shape our programs going forward based on what you tell us. So please do fill out the survey. We've got a lot of events scheduled through June and July. On July 13th, we're going to hold a very exciting event, Corporations and Climate, What Every Board Director Needs to Know. This is a regional program and we're working with NACD chapters from Connecticut, New Jersey, New York, and Pennsylvania. So that's going to be a fascinating program. September 2nd, we're going to be continuing our systemic racism series with our program, Leading Anti-Racism from Inside the Boardroom. I don't know about you, but every board I serve on, whether it's for-profit or not-for-profit, is really trying to come to grips of what to do at a board level to deal with the systemic racism we see in our economy, in our world, and in the companies that we are board members of. Our panel of executives and sitting directors will look at what top companies are doing to fight systemic racism, addressing the steps required to move forward. Some companies have begun this work, others have just started, and some of the rest of us are just beginning to ask questions. What's been successful and how do we support and grow this momentum? We've got a tremendous panel, including Tony Coles from the BAC Economic Alliance, Executive Chairman and CEO of Cerevel Therapeutics, Lee Pelton, President of the Boston Foundation, the incoming President of the Boston Foundation, and Kiana Schmeidel, Global Head Culture and Inclusion at Wayfair. And the moderator is going to be Micho Spring, whom we all know, the chair of Weber Shandwick and the global corporate practice and president here in New England. This is going to conclude our current program year. We're going to take a brief break, and then we're going to kick off with an in-person program. Yes, September 22nd, our first in-person event, our usual fall program called the Visionaries Speak. It's our event where we bring together leading corporate CEOs to let us know what they see as obstacles and opportunities for the upcoming year. So that's going to be a great program. You'll be getting a word from us on where it's going to be. It'll be in Sheridan, Boston, the timing of it, it'll be a breakfast, and who's on the panel. Thank you again for joining us, and don't forget to fill out your survey. Thanks so much, Eric.
Thank you.
Take care.